I don't see anybody saying, I'm too old to put money into an IRA at 60. I'm too old to put money into an IRA at 70. No, because what's happening is mom and dad die and we're left some inheritance or something crazy happens where we're getting an inheritance at 70. And what's the first thing you do? You dial up your phone and you call your broker and say, hey, you know what? I just got this $300,000 inheritance. I would like to put that into a IRA. Are you too old for that? Are you too old to deposit money in the bank? When you go to the bank, are they like, oh, excuse me, sir, but you look like you're over 65 years old, or you're 70, or you're 80. And so I'm sorry, but we can't take your money today because you're too old. You don't have time to make any money on interest anyway. So why do you want to put that money here? Hello, and welcome back to the podcast. Thank you very much for being here. All right. Today, let's talk about two things that people think, oh, just because I am uninsurable or I'm too old, I can't do the infinite banking concept. And so this is a huge misconception because if you guys get it, infinite banking is not life insurance. Life insurance is the tool. Infinite banking is the thought process. You can do that with a savings account. You can do that with money under your mattress. It does not matter. The life insurance is a piece that's going to give us uninterrupted compound interest. So let's talk about what happens if you're uninsurable. Doesn't matter. Hopefully, you have somebody else that is insurable within your life. That can be children, spouses, parents, business partners, right? All those things. But let's say that you don't have anybody else that you can insure. You're like, well, I can't do this then. So are you just going to throw away all the knowledge that you have about the utilization of money? Same thing if you're too old. People are like, oh, Mary Jo, I'm too old. I'm 55. Oh, for the love of Pete, 55 years old, who cares? You guys, I have a chapter in the book called Young versus Old. I swear to God, most of you don't read that chapter. Because until you're 75 or 80, are you really too old? I mean, come on. 65 is not too old. Is it too old to save a bunch of money for retirement? Yes. Is this a retirement strategy? No. Can it be used for retirement? Yes. But so many people are out there saying, oh, this is how we're going to retire. Great, fantastic. But we should be saying this is how we're going to create cash flow because we have liquidity of money. Okay, so let's just say you are too old. You think you're too old. You think you're uninsurable. We don't have anybody else to insure. Okay? We still have money coming to us. We still have to figure out how we're going to utilize money correctly. The most important business in the world is banking. Can you do that if you have cash? Yes. I don't care if you have a ton of cash underneath your mattress. Fantastic. Consider that your bank. If you're going to go buy a vehicle, put that cash back plus interest. If you're going to go on vacation, put that cash back plus interest. If you're going to use a savings account, use the savings account and pay it back plus interest. The only difference is you don't get the uninterrupted compound interest. But the thought process is the same. If we just took Dave Ramsey and included pay yourself back plus interest or pay yourself back plus interest, buy your vehicle, right? Dave says, oh, buy your vehicle with cash. Great, you guys are all savers. All the Dave Ramsey people in the world are amazing savers. You continue to essentially pay yourself back for that vehicle in the form of depositing money into a savings account. Are you paying yourself interest? If you're not, you should be, because that is the piece of the infinite banking concept that most people don't understand. There is a value to your money. There is lost opportunity cost. You are paying somebody else interest, or you have given up the ability to make interest. So if you have savings in a savings account, underneath a mattress, in inside of a coffee can, I don't care. If you have money that is saved that you are using cash for, then you need to pay yourself back plus interest. So let's just separate the whole I can't do IBC if I'm uninsurable or if I'm too old. Yes, you can. You absolutely can. The only reason you think you can't is because you think the life insurance piece is the IBC piece. They are not one and the same. You know, it's super interesting to me. When I go on to ChatGPT and I'm looking for things of like, what is the topic that I should cover today? AI is out there picking IBC and life insurance together. That means that too many people are talking about IBC and life insurance being the thing. They're two completely different things. They are not the same thing. And I will scream this from the rooftops until the day I die, because people need to understand this. And somebody got mad at me on some social media platform because I'm like, if you can't manage $1, you can't manage $1 million. It does not matter how much money somebody makes. If they can't manage $1, they're never going to be able to manage $1 million. Oh, that sounds familiar. Parkinson's law. Nelson went over that in the first half of his book. Why? Because that's IBC. That's the infinite banking concept. That's the concept. Life insurance is not a concept, it's a tool. And so if you are uninsurable and we don't have anybody to insure, it's okay. You can still use the concept. If you have a policy and your policy is not big enough to hold all the money, great. Then use a savings account until you can get that policy started. But we think, what if we're too old? And we're like, oh, we don't have, we can't do it. Well, can you insure your children? Can you insure business partners? Same thing as somebody that's uninsurable. But older people will say, well, it's not going to work because I don't have enough time to compound money. Okay, so do you have enough time in a savings account to compound money? Do you have enough time to compound money within a 401k and an IRA? I don't see anybody saying, I'm too old to put money into an IRA at 60. I'm too old to put money into an IRA at 70. No, because what's happening is mom and dad die and we're left some inheritance or something crazy happens where we're getting an inheritance at 70. And what's the first thing you do? You dial up your phone and you call your broker and say, hey, you know what? I just got this $300,000 inheritance. I would like to put that into a IRA. Are you too old for that? Are you too old to deposit money in the bank? When you go to the bank, are they like, oh, excuse me, sir, but you look like you're over 65 years old, or you're 70, or you're 80. And so I'm sorry, but we can't take your money today because you're too old. You don't have time to make any money on interest anyway. So why do you want to put that money here? The reason we think we're too old, the reason that we think we can't do this because we're uninsurable is right between our ears. It's because of all the noise out there saying you're too old, you can't be buying life insurance, you can't do this. It's the misunderstanding that the infinite banking concept is the tool. You 100% can do this. Go get yourself a mattress, cut a slit in it, put some money in there plus interest. I don't care. Is it going to work as efficiently? No, because we don't have the uninterrupted compounding piece. Are we going to get our mindset right? Absolutely. Absolutely. If we all just thought like Nelson told us to, we would not be in the position that we are in. Myron Golden is this new guy that I found that I'm listening to all his podcasts and I absolutely love him. He's fantastic. I always tell you guys, if you are debt-free, that does not matter. Does not matter because debt-free, the bum on the street is debt-free begging for cash flow, right? Myron Golden said being debt-free is being zero. Where is that going to get you? Zero is zero, right? Just because you're debt-free, you're at zero. Do we want to be at zero? No, we want to have cash flow. And he talks about the exact same thing. So this is absolutely wonderful that we have all this noise that says, oh, we need to pay everything off, but then don't pay ourselves back. What we don't understand is that we essentially, in most cases, if you are a good saver, you are paying yourself back. If you bought a vehicle, but you're saving $6,000 or $7,000 a month so you can go buy the next vehicle with cash, you're essentially paying yourself back. Because most people that are good savers will say, okay, I need to save so I can buy another car in 5 years or 10 years or whatever it is. And so you're saving all that money and you have a special savings account just for your car. You have a special savings account for your tires. You have a special savings account for vacation. So if you use the money in the vacation account, you go on vacation, you have a great time, everything is wonderful in the world, and then you come back from vacation and what do? You replenish that savings account because you want to go on vacation again next year. Well, are you replenishing that savings account with interest? Because the money that you used stopped earning interest in that savings account. You interrupted it. So are you going to pay yourself back plus interest? You're going to say, Mary Jo, I don't like payments. I'm not going to pay myself back. Yes, you are. You call it savings. I call it a payment. Does not matter. Same thing. And so if you think that you're too old, if you think that I can't do this because I'm not insurable, you absolutely can. You can implement the infinite banking concept. You may not be able to use the life insurance piece of it. Okay? So make sure that you are separating those two things. But if you have people in your life that you can insure, it's okay. We can just insure them as long as they're okay with it. So we're going to have business partners, kids, nieces, nephews. I have people that are insuring nieces and nephews because they've never had children. So people that don't have kids sometimes have nieces and nephews that they will help pay for their college. Well, now we have insurable interest in them because they owe us money for college, right? Or maybe we bought them a house. Maybe we helped them start a business. Whatever that looks like, now we have insurable interest in them and we can insure them. So you may just have to get creative. It's okay, but you have to have insurable interest. You can't just insure any old person, right? For no reason. But a lot of people think it has to be on themselves. That's not true. A lot of people think I have to have the policy in order to use the concept. That's not true. There you go. If you haven't read Becoming Your Own Banker yet, do it. Everything's in there. If you have the book and you haven't reread it, reread it. Get acquainted with what the concept is versus what we're trying to eliminate in the concept is lost opportunity cost. And so that's why we have the uninterrupted compound interest. That's why we use the life insurance policy. But it's not the end of the world. If we don't want to use the policy, we're just not going to benefit on the interest side and the dividend side. And so make sure that you're reading that book in conjunction with Life Without the Bank. A lot of people like to start with Life Without the Bank and then they go to Farming Without the Bank. So let me know if you have comments, questions, concerns, whatever. Happy to answer those. Read the book, reread the book, and then, schedule your time with me if you have not. You can go to the link that you got in your email. You can call us for a link if somebody else gave you the book. And we will give you a link to our calendars. You can schedule with myself or John. We can help you and determine if this is going to be right for you. But don't come in at 55 years old and be like, Mary Jo, I'm too old. I might go into coronary arrest, heart attack, whatever it's called. All right, you guys, you have a fantastic rest of your day.